If you're looking at rent-to-own homes right now, there is usually a reason behind it. Sometimes you found a house that you love, but your down payment is not quite there yet. Sometimes your credit is in recovery. Maybe sometimes your income is new, or you changed jobs, or you started a business and you know today is not the cleanest moment to apply for a mortgage. Rent-to-own can sound like a bridge. Move in now, work on finances, buy later. That's the promise people hear. The part that creates trouble is that rent-to-own is not one standardized program in mortgage lending. It's a private contract between a tenant and an owner. Mortgage rules only recognize certain parts of that contract, and only when they are written and documented in a very specific way. Some features of rent-to-own are simply business terms between two people. Other features directly affect whether a lender can count money towards your down payment. And some features people assume will help them later do nothing at all under underwriting guidelines. So in this video, I want to slow everything down and walk through rent-to-own the way a conventional lender has to look at it under Fannie Mae's current rules. We're going to talk about what rent-to-own actually is, what rent credit really means in underwriting, when conventional loans can recognize it, how that credit is calculated, what documentation matters, what commonly breaks it, and what federal consumer protection agencies warn buyers about in these deals. The goal here is clarity, not persuasion. If rent-to-own is the right bridge for you, you should understand the bridge before you step on it. In everyday conversation, rent-to-own usually means this. You rent a property for a period of time. There's an agreement that you may buy it later or that you will buy it later. There may be price written into that contract, or a future way the price will be set, or monthly rent that is higher than normal, or an upfront fee connected to the future purchase. All of that is contract structure. Mortgage underwriting does not care what marketing phrase is used. What lenders care about is this: what the contract actually says, what money moved, how it's documented, and whether the arrangement lines up with agency guidelines. That distinction matters because you can have a rent-to-own agreement that feels solid between you and the seller, but still produces zero usable credit towards a down payment when you apply for a loan. A lot of rent-to-own conversations revolve around one idea. I am paying rent anyway, so at least some of it is building my down payment. From a mortgage perspective, that is not automatic. For a conventional loan that follows Fannie Mae's selling guide, rent can only become a recognized down payment credit if the contract is written in a very specific way, the payments are documented in a very specific way, and the amount is calculated using a market rent comparison, not just what the seller promises. That last part is where many people get surprised. Under Fannie Mae's policy, rent credit with an option to purchase is pretty limited. It's not whatever the contract says. It's capped by the difference between the market rent for the property and the actual rent you paid. So if you paid above market rent, the portion above market rent may be eligible to count. But if you paid market rent, there is no excess to credit. If you paid below market rent, there is nothing at all to credit. The calculation is driven by the appraisal, not by opinion, not by websites, not by neighbors. An appraiser determines market rent. The appraiser determines market rent in the appraisal report, and that number anchors the math. When we talk about rent-to-own and conventional lending, we are really talking about one narrow policy inside of Fannie Mae's selling guide. That policy governs rent credit with an option to purchase. It allows part of rent payments to be credited towards the down payment or the borrower's minimum contribution, but only if very specific requirements are met. Here's what has to be true. The lease or rental agreement must include an option to purchase, show an original term of at least 12 months, state the total number of months, list the monthly rent amount, and list the monthly rent credit amount. The lender must be able to document a full payment history over the term, proof such as canceled checks, bank statements, or receipts, documentation that clearly shows the payee and the amount. The appraisal, in turn, must include an opinion of market rent for the property, and the rent credit that can be used is limited to the difference between that market rent and what you actually paid. That's the framework. It's precise, it's rule-based, and it's much narrower than how rent-to-own is often described online. Let's slow that part down because it drives the most confusion. Fannie Mae does not allow unlimited rent credit. The credit cannot exceed the amount you paid above market rent. So imagine this: an appraiser determines market rent is $2,000 a month. Your contracted rent is $2,350. The maximum eligible rent credit for underwriting purposes is $350 a month. Now imagine your contract says $700 per month will go towards your purchase. That may be true between you and the owner, but for the mortgage, the lender is still capped at $350 a month. Those two numbers can be very different. And when people plan around the higher number instead of the guideline number, that's where disappointment shows up later. Another detail people miss is the length of the agreement. The guideline is not simply that you have lived there for 12 months. The agreement itself has to be written with an original term of at least 12 months. It also has to spell out the rent credit, and the total length. A short lease with the verbal plans to extend later does not meet that requirement. Underwriters can only work with what is written and executed. They cannot rely on intentions. So if rent credit is part of your plan, the structure has to be there from the beginning. This is where many real-world situations fall apart. Even when the agreement is written correctly, the payment trail matters. Fannie Mae requires proof of what was paid and who it was paid to. That means consistent monthly payments matching the agreement, paid in a way that creates a record to the correct party. So common problems include paying in cash with no receipts, paying through transfers that do not show clear purpose, late payments followed by catch-up payments, paying someone whose name does not match the owner, partial payments that do not align with the lease. So from an underwriting standpoint, the question is not whether you meant to comply. The question is whether the documents prove compliance. If the paper trail is weak, the rent credit is at risk. It's also important to understand what this policy does not cover. For example, Fannie Mae separately addresses rent-back situations after closing. Those credits are not allowed to count towards down payment, closing cost, or reserves. That is a different concept from a rent-to-own. So not every payment tied to a property becomes usable funds in underwriting. The category matters. Many rent-to-own deals include an upfront payment. It might be called an option fee, a deposit, a purchase credit, or something similar. From a mortgage perspective, the key questions are: where did the funds come from? How are they paid? Who received them? How are they credited on the final purchase? And are they traceable? When you eventually apply for the mortgage, the lender still has to verify your assets, the movement of funds, and how the purchase contracts applies to those funds. If the paperwork is vague, or the payment cannot be documented, or the final purchase contract does not clearly credit it, it can create friction or delays. This is one of the moments where having a real estate attorney review the agreement is protective rather than excessive. A rent-to-own agreement does not bypass underwriting. It only delays it. When the time comes to buy, the lender is still going to evaluate your credit profile, your debt-to-income ratio, your employment and income stability, your assets, your bank statements, any debts, and the property. That is why timing matters. Rent-to-own works best when the lease period is used intentionally. That usually means repairing credit early, avoiding new consumer debt, building cash reserves, keeping your finances clean, and checking in with the lender well before the lease ends. Waiting until the final months to see whether you qualify leaves very little room to fix anything. Separate from mortgage guidelines, federal consumer protection agencies have issued long-standing warnings about rent-to-own arrangements. Those warnings are not about credit scores, they are about risk. Issues that have flagged in real-world cases include the seller not actually owning the property, unpaid property taxes, serious condition problems, promised repairs not being made, homes in foreclosure, deals being canceled after a single missed payment, and buyers losing money even after years of payments. Those are not underwriting problems. They are ownership and contract problems, and they can derail everything regardless of how strong your mortgage profile is. So in addition to asking whether a lender will count your rent credit, you'll also want to ask who owns the home today, whether title is clean, whether taxes are current, whether insurance is in place, what happens if the seller files bankruptcy, what happens if liens appear, and what happens if you cannot qualify later. Those questions protect your future self. Another common feature of rent-to-own deals is shifting maintenance responsibility to the tenant. Sometimes that includes appliances, HVAC, roof, plumbing, landscaping. Those costs add up. So if you're paying above market rent and also paying for major repairs, you are absorbing ownership type costs before actually owning the home. And that might still make sense in the right situation, but it should be a conscious decision written clearly into the agreement and not a surprise that shows up later. Some rent-to-own contracts lock in the purchase price. Others set it later. From a mortgage standpoint, the appraisal still matters at the time you buy. Lenders lend based off of the lower of the purchase price or appraised value. So if your contract price ends up higher than what the home actually appraises for, you may need extra cash, you may need to renegotiate, or a new plan altogether. That is another reason that rent-to-own should not rely on optimistic assumptions about the future value. When you finally apply for the mortgage, the lender is going to focus on 4 buckets: your financial profile, so income, employment, debts, credit, and assets; the rent credit documentation, so the executed agreement, the 12-month original term, proof of payments, and the appraisal market rent. Next is the transaction structure, so how credits appear in the purchase contracts, inducements to purchase, and seller concessions. And finally, the property, so the appraisal, the condition, the insurance, and the title work. Living in the home does not replace documentation. Before signing a rent-to-own agreement, slow down and work through these questions. Is this an option to purchase or an obligation to purchase? What fees am I paying upfront and how are they credited? How does the rent compare to market rent? What monthly rent credit is written into the agreement? Does the agreement have an original 12-month term with those figures spelled out? How will I pay each month so there is a clean record? Who handles repairs and major systems? Who owns the home today and is title clear? Are property taxes current? What happens if I cannot qualify later? What happens if the seller cannot perform? Those are not pessimistic questions, they are planning questions. Rent-to-own can make sense when your income is stable, your credit repair path is realistic, the payment fits your budget, you're still saving, the contract is clean, the owner is legitimate, and you treat the lease period as preparation time. It's usually a bad fit when the rent strains your budget, the rent credit is your only down payment plan, the agreement is vague, payments will not be traceable, maintenance obligations are heavy, penalties are severe for small mistakes, and ownership questions cannot be answered. Here's the clean takeaway. Rent-to-own is not a mortgage program. It's a contract structure. For conventional loans following Fannie Mae guidelines, rent credit with an option to purchase is tightly defined. The credit is capped by the difference between market rent and actual rent paid. Market rent comes from the appraisal. The agreement must show a 12-month original term with rent and rent credit amounts, and payments must be documented clearly. Outside of underwriting, federal consumer protection agencies continue to warn that these deals can carry risk if ownership, taxes, or contract terms are not handled carefully. So treat rent-to-own as a plan that needs structure, not as a guarantee. If you're thinking about a rent-to-own situation and want to understand how it affects your financing options, use the link below to book a call with my team. These conversations are most helpful early before a contract is signed because they can save time, stress, and surprises later. And if you want clear explanations about how lending rules actually work in today's market, make sure to subscribe. My goal is to help you make informed decisions with confidence and ultimately win with Wade. We'll see you in the next one. Bye-bye.